everyone, welcome to Economic Impact. Today is December 10th, 2024, and as usual, I am with our chief economist, Stéfane Marion. Stéfane, once again, stock market is going up.
Hi, good morning, Denis. It's been a great wealth effect for most households. We know that most portfolios are composed of equities. New all-time high on the MSCI All Country Index. So, it's striking how well the stock market is doing globally.
And is it worldwide or it's only North America phenomenon?
Well, you might not suspect this, Denis, but if I was to tell you what's the best stock market where's the country where the stock market's performing the best so far in Q4?
I saw the slide then.
Well, yeah, okay. So Canada, we're up almost 8% quarter to date, outperforming the rest of the world. Year to date, we have a 24% gain, exceeded only by the US at 28%. I can bet you that not many people thought Canada would follow the US as well as it has in 2024.
But Stéfane, are we catching up in Canada versus the US because our price earning ratio are lower?
Yeah, we spoke to that a few quarters ago, saying that it was abnormal to see this discount on Canada versus US on the stock market perspective. So you're absolutely right that there's a catch-up phase here. Half of the gains on the S&P TSX this year were accounted by PE expansion. Yet, Denis, despite this catch-up, we're still trading at a historical discount to the US. So if I was to qualify the Canadian stock market right now, I would not call it overvalued. It's fairly valued, but not overvalued. For the US, it's probably a different connotation.
Okay, and now if we go back to economy, the exportation, I think we need to talk about that.
Well, people thought that the Canadian stock market would be under pressure this quarter because of the potential threat of tariffs coming from the US. I know the president-elect spoke to 25%. 25% would be a massive deal on Canada, Denis, because we have $600 billion of exports going to the US. That's 25% of GDP. So, slapping 25% tariffs on that would seriously fragilize the Canadian economy and probably the stock market.
And we can talk about crude oil because people, I don't think they know how much exportation we're doing to the state.
So the reason the market is not buying into the 25% tariff structure is because they know full well that the president-elect has promised the Americans that they would get affordable energy going forward. So if you impose a 25% tariff on Canada, which accounts for 62% of US imports of crude oil, we are now shipping 4 billion barrels a day, million barrels a day to the US right now. You would certainly ignite inflationary pressures in the US. So that's why the component of the Canadian stock market that's performing so well in Q4, aside from the IT sector, is the energy sector, because the market is saying, no, there's no way Washington can put 25% of tariff without fragilizing its own economy.
Okay, Stéfane, but there's something that doesn't add up here. Why the Canadian dollar is so low compared to the US dollar, despite that?
Well, for some people, it's a conundrum because the models are broken, because normally you have an historical relationship between the Canadian dollar and the price of oil. We also include, interest rate spreads on that one. So what is striking this time is that the Canadian dollar is so cheap, 140, more than 140 versus US dollar, and the oil is trading at $70. We've never seen this combination in the past. Whenever the Canadian dollar traded at current levels, oil was trading at no more than $30. So obviously it's a revenue boon for the energy producers, but from a purchasing power, it's quite frustrating. So a lot of people are saying, why is the relationship broken between oil prices and the exchange rate?
Okay, but how are you explaining that? Is it because of the employment?
Interest rate spreads, so economic performance, the relative economic performance in Canada versus the US. We're not doing very well right now. The unemployment rate at 6.8% last month. Versus US at 4.2%. So the markets have jumped on this, and they are now saying that we can justify a divergence in monetary policy between the two countries.
Okay, what's your call on the next Bank of Canada rate cut or not?
Well, the market is calling 90% odds that they'll be cutting rates 50 basis points.
50?
Yeah, 50 basis points. So we got to get closer to 3% as quickly as possible. Denis, I want to bring your attention to the fact that this gap in the unemployment rate is the widest we've seen since 2001, so over 20 years. So yes, you can justify this. And so the Canadian dollar is trading on rate differentials between Canada and the US as opposed to oil prices.
Well, it's the end of the year, and now we need to look at 2025. How does it look?
More uncertainty, Denis. Yeah. So uncertainty can bring positive surprises, but also can be challenging for markets or the economy. The reality, if we look at economic policy uncertainty in the US right now, it has surged. The president-elect is not yet sitting in the White House, and there's a whole bunch of policies that have been thrown out there. We know that there might be a tariff war between China and the US, not just Canada and Mexico. So we're reinventing the global supply chain. It's uncertain what it means to inflation and expectations down the road. The president wants to avoid inflation expectations to rise, but this is pretty acute in terms of policy uncertainty right now.
And this is a fairly high level, even if you compare to 2016 when he was first elected.
Well, we've never seen, outside COVID, you have to go back to 2012, where it was the debt crisis in Eurozone. US was downgraded back then. Don't forget that. Mm-hmm. And there was also the beginning of a war in Syria, which is reigniting again. So we'll see what happens.
The story is back again.
Yeah, so that can bring more challenges for markets. So again, this is, not everything is so calm looking into 2025.
And we had two really spectacular years in terms of performance.
Yeah, so the message is don't be greedy when we've had two exceptional years of market returns. Doesn't matter which asset classes, 2024 is just as good as 2023. It's exceptional to see back-to-back years like that. So again, looking into 2025, there are still uncertainties, so just be comfortable with your current asset mix and whether it respects your investment horizon. If not, then just give the calls that need to be made. But again, I can't promise you a third year of exceptional returns given the uncertainty that we see out there.
Well, on that, Stéfane, thank you very much. Thank you for all of you to participate and to listen to our monthly Economic Impact. On behalf of the technical team of Economic Impact, on behalf of Stéfane and myself, we wish you a happy holidays, and hopefully we'll see you back in 2025.